Okay, so let's see where this goes. I have a lot of slides, and we'll let you decide where it goes, and I'll just be ruthless if I have to. Interestingly, over the years, with scandals like Enron and the latest crisis, all I can say being an accountant is those things are really great for business, right? And I think there's like little doubt at this point. People have at least bought into this, which literally was not always the case, that accounting actually matters, right? It's not just a little window dressing type of thing. It's a fundamental aspect. It is like the information system. And so I'm going to lead up to some of my research, but there's a pretty significant front end here because I think contexting this is actually quite important. So ask questions wherever you want as this thing rolls on. So where are we today? Well, accounting is important, but the question is it just so important that the accountants just can't handle it anymore, right? And we need some politicians. You know, I've taught intro, at Chicago and other places I've taught intro financial accounting, and one thing you learn is some people just don't get it, right? Like, just really smart people just don't get it. I don't know what it is. And I suspect there's a few of those in the political class, but they're very confident in their lack of knowledge. So let me just show you some of the things that are going on here. There's no doubt about it that with this latest crisis, there's this huge impetus right now for changing regulation. Now, it's getting all mucked up and it's going all over the place, and who knows what it's going to end up being. But let there be no doubt that there's still lots of momentum for that. And in particular, to context my talk today, a lot of momentum is involved with changing accounting rules, basically grabbing control of accounting rules with the objective of achieving some sort of making accounting subservient to financial stability, okay? And I'll take you through some of that. Now, to motivate the title of the talk, there's a famous notion called the Nirvana fallacy that was basically is attributed oftentimes to an economist named Harold Demsetz. Well, let's think about regulation itself. What creates the impetus for regulation is always some sort of notion of market failure. Something's broken, right? Something's not working. If you let the market left to its own is not working, okay? And so that's always the start. But of course, what we do when the market's broken is not so clear. So in other words, the logical chain is not necessarily the market's broken, therefore we need the government to fix it, right? Because there's certain imperfections in the government as well. I don't even have to motivate that one very hard. Yes, sir.
Well, I wanted to talk for a second, or bring up for a second the news over the course of the weekend that the government of Greece was misreporting its finances to the rest of Europe using derivatives. They were using derivatives rolled over at below market rates in order to change their accounting. So I just wanted to point out that it's not, that when governments are in charge of accounting, it doesn't mean that the accounting is necessarily going to be any better.
Let me just build on that a little bit.
I thought you might.
One of the big things that's been discussed in recent years for corporate reporting has been the notion of off-balance sheet entities and off-balance sheet debt. If you look at the U.S. government and various others, and you look at what they report to you as the finances of the U.S. government, the amount of off-balance sheet debt and off-balance sheet entities is so dramatic that if we were to actually create the fundamental balance sheet of the U.S., so right now, what's happened in accounting is banks are being forced to bring a lot more off-balance sheet entities onto the balance sheet. It's going to be very difficult from here on in to get things off the balance sheet. But the problem there is minor compared to the off-balance sheet issues with the government. So, but you know, I'll buy that cynical note that if you put the governments in charge of their own accounting, they'll screw you over when necessary, right? From their viewpoint. You know, I don't know how you view how politicians. They're not all the same. There are some, you know, pure, you know, truth, light, and justice types of individuals in the human race. But there are also many self-interested people, and power corrupts. So the Nirvana fallacy, all it says is, if I see something broken, right, the way it's often presented to you, but the fallacy is, you can't compare it to some dreamland type of government solution where you're idealizing what the government's able to do, where you're idealizing a well-incented, altruistic organization that has all the information necessary to make the right decisions. And so let's look at accounting. And so the question is this interference leading us to Nirvana or somewhere else? Okay? So let me just show you a couple of them before we get into the heart of the matter here. This was an interesting one recently. Now, this got defeated, but it just kind of shows what's going on. In the U.S. House of Representatives, Representative Edward Perlmutter put forth an amendment that basically would give a board of bank regulators, they would call it like a systemic risk council, control over accounting standards. So in other words, anytime an accounting rule was moving through the process, this organization would have one of these kind of roles over it. So literally taking the accounting rulemaking, which now in the US falls under the SEC, and giving it to some new group, a board of regulators, again, politically appointed regulators. And so, you know, one has to ask, is that going to lead us to some happy ending or not? Okay? Secondly, and this is a double-edged sword, as many of you know, there's international accounting standards now that are done by the International Accounting Standards Board, the IFRSs. And the International Accounting Standard Board has been living in kind of a nirvana, right? And here's their nirvana. They were writing all these rules, but nobody was using them, right? So there was no pressure on them because nobody was using them. Now all of a sudden, country after country after country is adopting IFRS standards, and all of a sudden, the political force coming down on the ISB is tremendous, right? And in fact, this is just one example, because over the years, the European Union has almost come to think that it's theirs, right? That the ISB is kind of European Union. But of course, as we see, countries like China and India are adopting it, and it's not clear who's going to own that, and it's not clear what's going to happen there. But what we saw here was, under pressure from the banking lobby in Europe, the Europeans have basically stepped out of this new financial instruments rule. Again, it's a power play on their part to try to get the rule shaped to the way they want it. And when you've got individual blocks, political blocks intervening in the process, things like this harmonized world where we all have one big happy set of accounting rules looks really unlikely to happen anytime soon. And in fact, that's not necessarily a bad thing. Think of it this way. Think about accounting rules. Let's say it's really hard to come up with the right ones, which I think it is. And the way you learn what the right ones are is you try some out and see what happens. So you actually dump them on the world and see what happens. So if we don't know what the right answer is, maybe if we have multiple groups setting standards independently and coming up with different rules, we could get to the right answer faster, because if we have two of them, we could run two experiments side by side rather than running one, see that it fails, then agreeing on the next one. We could run multiple experiments at once. But anyway, punchline of this slide is politics is now intervening in international standards in a big way, and it's very likely what we're going to see is some sort of different standards everywhere in the end. There'll be probably more cohesion than there was before, but you're going to see lots of differences arising here because politics have this inevitability to them, yes?
So what's the metric you use to measure whether one is working or one isn't?
Well, you know, usually what it is some sort of meltdown or problem that arises. Sometimes they come out naturally in practice by just people complaining. But for example, when Enron occurred, it was pretty clear at that point that the rules for off-balance sheet entities was broken, and they tried another set, right? And now we see again it's broken again, and now there's actually another set being put in place now. So meltdowns are a big one, and a lot of times it just comes out through complaining by various parties in the process, because there is a due process scenario set up. But it's not science, it's art and politics and horse trading in the end that comes down to what ultimately dictates what accounting rules come out. Okay, one more before I get into the heart. So during the recent crisis, you couldn't help but every day like hearing about how fair value accounting or mark-to-market accounting was destroying the world as we know it. And so during this thing, there was huge pressure on the standard setters to relieve some kind of pressure valve. And the basic pressure valve was to allow companies to avoid some of these write-downs, right? And it came about in a number of ways, but both the IASB and the FASB cracked under the political pressure that was being pounded down on them. And in essence, what they did was they allowed banks a lot more flexibility. Right? You could put them into categories that didn't affect your capital, for example, because the gains and losses would go right to owner's equity. Or they would allow you to classify securities across different portfolios because the accounting treatment differed. So in other words, they cracked and they allowed significant additional flexibility into the process. And so a deep question here is, and I'll return to this later, whether or not this pressure, because politicians, are responding to pressure, didn't actually have the opposite effect what you would hope for, in that it created what's known as regulatory forbearance. So think about it this way. You have a banking system, you have regulators, and they're supposed to be overseeing this. Well, if something's broken, what you want is prompt corrective action of some sort, okay? Regulatory forbearance is the situation where something's broken but the regulators don't intervene. It's a fundamental, deep problem that arises in bank regulations, probably for centuries at this point, right? And so what you wonder is, in this case, was accounting fundamentally used as a mechanism to generate regulatory forbearance, where now you've got broken banks that are not actually reflecting their true economics and keeping the regulators out. In fact, a couple weeks ago, I was at Tilburg University presenting to a group of bank economists, and one of them argued to me that if these rules made accounting less transparent, that's actually a good thing, because if people actually knew how bad everything was, there'd be a panic. So he was actually arguing that having banks be opaque and outsiders being actually unable to evaluate what's going on is a good thing. Okay? So what's the problem with them? Yeah. That's, but I'm going to argue in a little while that the numbers themselves can create the economics. Let me hold your question for a minute, and let's come back to that. Steve. Absolutely. it's serious. It's a serious problem, right?
We can't damn them for what they're trying to do. What they're trying to do needs to be done. It's just that there's not a good maybe not a good mechanism for it.
Right. Part of the argument I'm making today is that we ought to separate the accounting from the bank regulation. And in fact, if bank regulators feel like they need to do something, they could actually intervene and define capital a different way, or change the way bank capital is computed, say, through the business cycle. And that what you don't want to do is you don't want to allow the accounting itself to break down such that you can't tell what's going on anymore in the economy. In fact, let me show you the classic argument. This is very elegant and beautiful. And I'm going to do it through a series of little simple balance sheets, and you'll get it right away. It's like, the logic is just really amazing. So a big issue, and an issue that I have a great interest in, is the connection between accounting and financial stability. That's kind of the theme of the talk today. Let me show you the argument. Here's what it plays off of. In a mark-to-market world or in a fair value world, when an asset values change, we immediately reflect those changes in our balance sheet, and they immediately feed down to the equity section of the bank. Okay? So it's a continuous process because we're using mark-to-market. It happens very, very quickly. And so as these things flow to the balance sheet, as I'm going to show you, financial institutions are fundamentally balance sheet managers. That's what they do for a living. And these changes immediately lead to a response by the banks. As their balance sheets change, they respond in their investment behavior. And in essence, the argument I'm going to show you now is what people argue is what mark-to-market accounting does is synchronizes behavior across many banks simultaneously. So where we typically think of accounting as affecting one company at a time, what happens is because these asset prices are changing and lots of banks have those assets on their balance sheets at the same time, fair value accounting is literally leading to a correlated behavior across many banks. And let me show you the argument. It's very cute how it works. So we'll start with one financial intermediary here. And this financial intermediary, its form of balance sheet management is it always seeks to have a leverage ratio equal to 10, where I'm just defining leverage for you there. It's assets divided by equity. And that's the common definition of leverage used in the financial industry. Now, let's look at their opening balance sheet. They've got securities. We'll keep this real simple. Securities of 100, debt of 90, equity of 10. So we're starting right at the target leverage. Okay, so what we want to do is muck this up, right? And let's see what the bank does. So, first iteration. In my arguments, I'm going to assume that when the price of the securities change, I'm just going to hold the value of the debt constant. So everything's going to flow to owner's equity here, okay? So imagine that security prices go up by 1%, a $1 change in the value of the securities, okay? So the securities move to 101 and equity moves to 11, where debt stays the same. Notice that our leverage ratio is now significantly below our target leverage. So what a balance sheet managing organization does is levers up, okay? So the response here is to lever up, I go out and I borrow $9 more and I invest $9 more in securities. So a $1 change in value by changing my leverage ratio kicked off a change in my balance sheet of 9 up to 110. So notice that what's going on here is that little change in leverage led me out into the market to buy more securities. Now, if everybody's doing that, there's a lot of demand pressure on securities, okay? Notice there's also something very unusual about this example. Usually we think about when price goes up, we demand less of something. Notice that when we have balance sheet management, you get an upward sloping demand curve, meaning prices go up and we want more of it. It's a very funny scenario that kind of is a driver here. Now, of course, you have to do the what goes up must come down part of this, okay? So let the security price drop by $1. down to 109. Notice that we're over-levered now. So what do we have to do? Deleverage. So this is the famous deleveraging that people talk about. I've shot beyond my target leverage. I have to deleverage. So what I do now is I dump $9 worth of securities onto the market and pay down debt. So again, if this security is held on every bank's assets in the economy, we all are delevering at once here, right? By selling those, so let me just show you this is not hypothetical. Here's some data. So here's what you're looking at. This is on the x-axis, we have leverage growth. On the y-axis, we have growth in total assets. Right? So think of this as the fair value, think of this as the response in leverage. This is for commercial banks. Notice that everything is formulating around, this is leverage growth, everything is formulating around 0. What does that mean? That means when asset values change, banks seek to keep their leverage ratio constant. So leverage is forming around 0 here. So this picture is showing you exactly the dynamic I just showed you in that little example, where we have a fixed leverage ratio, and what the financial institution is doing is managing to that leverage ratio, okay? Now, this is commercial banks. Now, let's go to the rocket fuel, and the rocket fuel here will be, the data is securities dealers and brokers. One can only imagine things like hedge funds and other things that are operating underneath here that are maybe even are more rocket fuel than this. But notice what we're getting here is a slanted line now. In other words, if you look at this, what's happening is when asset values go up, we're actually increasing our leverage, right? So a change in balance sheet leads to a higher leverage. So not only are we going up by 9, as I showed you before, we're going up by more than 9 for every small increase. Yes, sir?
I believe the main reason is that unlike the banks, which can borrow unsecured in an infinite amount, the securities dealers are borrowing based on collateral.
Exactly.
And so as the collateral values change, then they're forced. It's not a matter of leverage policy. It's a matter of the margin clerk's policy at the bank.
Yeah.
So indeed, the hedge funds would certainly show the same result.
Absolutely. There's no doubt about it. In fact, let me just show you some individual financial institutions. So we got Bear Stearns, Citigroup, Goldman, Lehman, Merrill, and Morgan. That's what they look like, right? So they're acting like investment banks or like, hedge funds act. And so mark to market, the point here is that we could get if all of this hits balance sheets simultaneously, we get a lot of people moving in the same direction. And in this case, the whole idea to get out of this is that it's an exaggerated movement. So a small change in the value of the assets leads to a huge increased demand for the assets in the marketplace. And so let me go to the punchline of this little argument for you. The feedback effect, as it's called, right? So think about what happens here. So we start with an increase in assets. So let's look at the pink one first, right? Because the turquoise one is just the opposite on the way down. They work the same way, basically, right? We have an increase in asset price, right? Bam, that rolls right through down to my equity. I'm under-levered. I have to go out in the market and buy more securities. Well, if everybody's doing that at once, we've got all this demand pressure hitting the market, which is driving prices up. Well, when prices get driven up, I market to market, and my equity increases again, and I'm under-levered again, and I go back out into the market, the demand pressure increases, it's a loop, right? It just feeds back into itself, and in essence, lots of leverage could build up in the economy from simply this feedback loop as it occurs. Well, of course, the opposite happens here. As when asset prices go down, I'm over-levered, I dump, right? There's now excess supply of securities in the market. The prices go down, mark to market, it decreases my equity again. I'm over-levered. I dump more, and you can get these deep fundamental deleveraging loops that occur. So as Steve was raising before, this is not trivial, right? This is not a small problem. This is a real problem. And I think it's clear some of these dynamics likely were playing out. Now, the question here, of course, is the accounting the right way to fix this, right? I mean, one could also put restrictions on leverage and on leverage growth. One could make leverage requirements based on cyclical elements of the economy. It doesn't necessarily have to come through the accounting. So, and Steve made this point very clear. There's a trade-off here, right? Because if you start playing around with the accounting, oftentimes what the end product is you demean the transparency of the system. I can't see what's going on anymore. And the question is the right way to deal with this is to allow the system to become opaque, or should we seek to make the system as transparent as possible, and around that transparency, build a regulatory structure that deals with the problem separately from the accounting? And I think that's really one of the deep debates that's out there right now. Should we use the accounting? Well, okay, that's my next slide. Well, there are some benefits to it. One benefit is, if I change the accounting rule, every bank is affected in exactly the same way, and I could free ride as a regulator. I could free ride off the fact that the books of the banks have to be audited by external auditors. So the regulatory change affects everybody and automatically goes through some sort of a scrutiny that I don't have to pay any more to get, because the audit already has to occur. Now, those aren't free. I mean, that comes out in audit fees and the like, but the regulatory apparatus itself doesn't have to bear that cost. And then the other side, of course, is the transparency side. And remember, there's companies in the economy other than banks. They're not the only firms in the economy. So if we start screwing with the transparency of the economic system itself, in order to try to achieve some sort of bank stability, what are the unintended consequences of that as that ripples through to the many, many different aspects that are affected by transparency, including little minor things like the efficient flow of capital and corporate governance. If I can't see what's going on, it's really hard for me to do anything about it. Okay? So, that's the, yes, Well, this is real data.
You're forced by the margin calls. So that's how it is in the market today. There's no choice in it. It's not a policy.
Yeah, so I don't know what happens if the price goes up. Do the margins go down?
If the price goes up, you can borrow more.
You can borrow more against it.
Yeah.
And they're always, they push it always to the limit, right?
I mean, almost. I mean, having worked in the Treasury at Drexel, for example, you're borrowing every last bit that you can at every moment. Because you can't sell from an empty cart.
Yeah. I mean, what you want to do is you want to make money off of somebody else's money, basically. So anytime there's a degree of freedom in the system that allows you to achieve more leverage, you do. Steve.
I don't disagree with
Yeah.
you, Joel, but how do you handle this? Effectively, the ones who want to take this out, we don't want someone to get a fire.
Yeah.
So if they don't know it's on fire, nobody will.
Yeah.
So if you have complete transparency, what you're going to have is there's a little fire burning in the theater.
Yeah.
But trust us as the regulator, you don't need to worry about it. You'll know about what to do. So is that trust going to be?
Yep.
Because the fire will be there because the accounting is transparent. We know the situation. The bank is way undercapitalized technically at this moment. But trust us, it's okay.
Yeah.
That kind of stuff.
You know, it's interesting because that's one of the arguments that's out there, but there's a counter argument to that that goes like this. So Steve's is, I don't know what's going on. So even if there's a fire, I don't know. Although, man, I don't know if there's a fire. I want to get the hell out of the theater personally. But I mean, I've watched one too many episodes of CSI when they get caught inside the theater. But the argument on the other side goes like this. I don't know where panic, say some sort of panic or fear starts mounting in the economy, right? Well, the argument goes, if banks are transparent, then I could look at them and I could differentiate the weak banks from the strong banks. So I don't just get this blind panic where everybody's running to take their deposits out of the bank, where I get a more discriminating kind of movement, and the weak banks do suffer during that. So it's the other side of that argument, and you know, if you look at the sweep of economic literature over the last 25 or 30 years, you can get both of those to be kind of the right answer, right? It's very subtle as to what the underlying nature are that makes, you know, transparency bad. It's just, you know, again, it's just my gut that says, if there is a fire and I'm in the theater, I just want to know, right? I don't want to be burned alive. I don't think. I'm not sure. Because I've never been burned alive. I don't know what it could be cool. Okay, now, this notion is built right into the heart of bank regulation itself. So if you look at, the Basel II Capital Accords, so the Bank of International Settlement basically sets these international banking standards. Right now, these are built around, they call them pillars. So pillar one is that we're going to control the capital requirements of the bank. How much equity do you have to hold against your risk? Okay. We're going to have a strong supervisory oversight function. And the third one, which to me is the one that brings me into this and brings the accountants into this, is this notion of market discipline, the third pillar. And what market discipline is all about is the idea that if I supply the market with information about the bank, then the market, through its pricing and through its various mechanisms that it has to exert pressure on firms, will incorporate that and literally put pressure on firms. So in other words, if I have a subordinated debt contract, by subordinated means the government's not insuring it, so I could actually lose my money. Of course, if the politicians get involved, then there's some kind of random number generator that decides whether I lose my money or not. But generally, if we get people to realize if you're like in a subordinated position, you could actually lose your money. And let's say they've got floating rate interest, right? Well, if they are able to observe the bank's behavior and they see that they're increasing their risk, they'll punish them with a higher cost of capital immediately. The banks will know that and will not increase their risk. There's an internal check on that. So in other words, at the heart of the Basel Accords is the notion that transparency itself could be one of the fundamental principles of bank regulation. It's not the only, it's one of three pillars, and it's usually thought to be complementary to the other two. But if I squelch transparency, if I make it go away, I'm going to get nothing out of that, right? If outside investors can't tell what's going on, they're not going to be able to do anything about it, right? They're on the outside, they're not on the inside. They don't theoretically have any inside information. They have to rely on what they could see and what they could understand about the banks. So built into the bank regulation itself is an internal demand for transparency. So one thing for sure is, and you know, Steve is kind of bringing out that there really, it's very complicated, but lots of contradictions are running through this because you can't have everything, right? You can't have opaque markets and market discipline. Okay. So let's move into my research, but of course, I need to set this up because I don't know how much everybody knows about this. So what's going on right now? Well, what's going on right now is this regulatory push that I was talking about. But I'm just going to cherry pick a couple of these because this is what kind of feeds into my research. Two, I guess you would call them pretty important organizations. The Financial Stability Forum, which is actually now known as the Financial Stability Board. It's actually a subunit of like the G20 or something. And the US Treasury have put out fundamental proposals. And what I want to really talk about now is loan loss accounting. right? I'll define everything in here because I don't know what anybody knows, but they're saying that they don't like the model that's being used right now. They argue that the model being used right now is a backwards-looking model, and what we need is we need to give banks a significant additional flexibility to look forward and way off into the future and record loan losses earlier in the business cycle, right? Rather than waiting till. So what happens is, and the data just shows this all over the place, when the economy's on a rise, there's very few loan losses, right? What we're doing is making a lot of loans, and we're moving up the loan growth is very steep, and we're putting very small amounts away into loan loss reserves. But the argument goes, well, when you're in these upswings, that's when the risk that's going to come and bite you later is actually being built up. So if we can allow banks the flexibility to record loan losses and reserves earlier in the process, we could somehow prevent this meltdown scenario. Oftentimes, pro-cyclicality is the word, which just says when things go bad, something else comes on and piles on and even makes it worse, right? So let me develop this quickly for you. So here's the current accounting model. It's called the incurred loss model. It's been around forever, right? This thing has just been around forever. And what it says is that you can only record loan loss reserves, and I'll remind you of the journal entry in a minute in case you're a little rusty on this. What it says is you can only record loan loss reserves for losses when the loans are actually already on your books and some event has already occurred that leads you to believe that a loss is probable. So in other words, it's rooted in an event that has to have already happened. So there's an anchoring into the past. The event has to have occurred. Now, that orientation has always been there to prevent banks from simply mucking with the numbers, like playing around with their loan loss reserves to achieve whatever it is they want, like smooth income, for example. Okay, incurred loss model. Now, the regulatory view, in fact, let me get a balance sheet out for you, okay? So, loan loss reserves, what we do is we debit an expense account, and we build up a reserve for loan losses, which sits on the balance sheet, right? And if you look at this is like an expanded balance sheet here. Assets, deposit liabilities, uninsured liabilities, and I'm going to put the loan loss reserves here, although as most of you know, in the balance sheet, this is usually simply netted directly against the assets on the asset side. Doesn't matter. This is where it conceptually sits. So notice what we have here. Here's the deposit liabilities. We've got equity. So if the bank starts losing money, I've got this equity cushion to absorb those losses. If I absorb that equity cushion, then I've got these loan loss reserves that have started absorbing losses. So in other words, I'm putting firewalls up before I get to this thing where the government actually has to step in and make good on their deposit insurance, right? Now, if anybody wants these slides, I give them to you. Here's the argument. If we look at these two things, it's just easier with the picture up. The bankers argue that these two things serve dramatically different roles in the world. What loan loss reserves are supposed to do is protect us against expected losses, right? These are losses we expect to happen, okay? Then equity becomes a real cushion against all the unknowns, all the things that could come out of nowhere and get to us. So the bankers are arguing what we really want is this brutal separation where we want to allow banks to fully and completely in their loan loss accounting reflect all unexpected losses. Because if we allow them to do that, that means equity is clean in the sense of I don't have to keep any equity around to cover expected losses because I've got this other mechanism that I've built up to handle those. Now I could start looking at how big an equity cushion do I need to prevent unexpected losses. Now, what the right answer to that is, I don't know. But the idea is now we have kind of a clean mechanism where this thing is purged of expected losses. That's kind of the logic here. And that logic leads to the argument of we need to free the banks up away from this incurred loss model so they can start looking way forward into the future and recording all the expected losses that they could think of, right? Well, let me just show you a couple numbers here. So this is Citigroup. This is the latest financials I could find from them. So this little area here is what I'm forcing you to look at. This is their income statement. So these are their provisions for loan loss, their expense. So notice in the 9 months ended September 30th, 2009, for that 9 months they've already recorded, I think you add 6 zeros onto this, right? So that's $31 billion in loan losses versus $21.5 billion for the same 9 months in 2008. And this is for the last 3 months ended in September, almost $9 billion. But you were asking a balance sheet question. So this is their balance sheet. So at 9/30, their loan portfolio is $622 billion. Their loan loss reserve here is about $36.5 billion. Right? Now that's probably, I think this is a bank that's got some mushy assets in there. So it's going to depend on what proportion they are. Yes, sir.
So if I read that correctly, their income statement, their loan loss provisioning, is as fast as their incurrence of loan losses?
It looks that way.
Yeah.
Close,
Okay.
right? Because, yeah, good point. I was noticing that too. So here's what he's saying, that they've recorded about $31 billion in loan losses in the first 9 months here. And if you look at the loan loss reserve, which is the balance sheet, accumulated is 36. So a lot of that 36 has simply been set up in the last 9 months, right? Yeah.
The reserves are for losses that have not occurred yet, correctly? And then when the losses actually occur, that
There's a separate charge-off.
moves.
Well, yeah, so when the actual loan goes bad, we don't hit the income statement again. All we do is we use the reserve to reflect that the asset's gone, that the loan's gone. So just credit loan, debit reserve, just clear it off the books completely. But it's a nothing entry in the sense of it doesn't affect total assets, it doesn't affect the income statement. It does affect the size of the reserve though. Okay?
It probably affects the price of it. We're writing
what
it
do you mean
down
by that?
as you go.
What do you mean by it affects the price of the asset?
Well, the price of the asset is based on some probability distribution of future losses. And then when the loss is actually incurred, that probability goes to 1.
Oh, and that one, yeah. I mean, theoretically, the loan value goes to whatever I can get out of the collateral, you know. But interestingly, this is an argument I'll come back to. The fact is that I can observe this. They're showing me this. So notice that by seeing how much they're recording in loan loss provisions, I'm getting a feeling for the underlying characteristics of their loan portfolio itself. Loan provisioning itself is a manifestation of the risk of loss embedded in the underlying portfolio. So if I play around with that, so when people start talking about mucking around with the loan loss provisioning, what you're talking about conceptually is potentially destroying information about the underlying characteristics of the loan portfolio itself. And I'm going to show you evidence in a minute that that's exactly what happens under certain circumstances. Okay, let me just give you a quick update on what's going on in the world with loan loss accounting. By the way, I'm going to show you another manifestation of politics now, in that the IASB and the FASB did this blood brother thing a few years ago, like, you cut your hand and shake hands and we're blood brothers and we're going to harmonize all accounting rules forever. Well, blood brothership don't last that long in this world, right? Its politics are driving the two organizations in a different direction. The FASB is going whole hog fair value. okay? So things that you've always known and loved, like the 3 portfolios for marketable securities, gone, right? Everything is going to be fair valued under this proposal. That you can see that this is the date I picked this one up. Everything's going to go to the income statement. So when I fair value it, everything goes to the income statement. So why are they getting rid of the portfolios? Because they're trying to get rid of what's called regulatory arbitrage, where banks and everybody else starts mucking around with which portfolio they put things in to try to get a particular accounting treatment, right? So if I remove all those portfolios and I say it's fair value all the time, there's no place to run, no place to hide. I mean, now you're down to just mucking with what the fair values are, right? Which is, that's pretty hard itself to kind of choke down. But here's the one thing I wanted to point out here. They're also, for the very first time, going to require bank loan, the loans on banks' books, to be fair valued as well. That is not the case right now. Loans are held on bank balance sheets at amortized cost. So this is a huge change. But here's their compromise here. This is the political compromise now. For bank loans, when we mark the bank loans to market, we're going to let some of it not go to the income statement. We're going to let some of it go directly to owner's equity, and some of it's going to go to the income statement. What's the split? Any part of the change in value that's due to change in credit losses has to go to the income statement. Any portion of the change in the loan's value due to, say, changes in interest rates, we're going to allow you to put it in owner's equity directly and bypass the income statement. Now, their reasoning there is they're going to try to create some semblance of keeping the old system around, where I'm going to have something in my income statement analogous to a loan loss provision. But now it'll be the change in the value of the loans due to changes in my expectations of future loan losses. And the incurred loss model is gone, because now you can consider a whole range of things, including political data, whatever that means, right? In other words, the old model, which was rooted in the incurred loss where something has to happen, is gone now. And now you can incorporate anything you want that's relevant. So as I'll argue, what does this do? Well, it's got the possibility of allowing the banks to embed a lot more good information into their accounting. It's also got the possibility of allowing banks to play around with the numbers. Because as I start allowing mushier and mushier and more speculative types of information to be the basis for my economic decisions, it's going to be very, very hard to know whether that's right or wrong, and that scope can be opportunistically abused. So it's a double-edged sword. Okay, quickly on the IAS, because they're going exactly the other direction. Again, political pressure. Certain groups do not want fair value accounting. So IFRS, under pressure from the banking lobbies, particularly in the European Union, have basically come up with a model. And I've just put these two things, these characteristics. If you read these characteristics, the first thing that should come to your mind is, boy, bank loans are going to meet both of those criteria right away. And if you meet these criterion under IFRS 9, you don't have to use fair value accounting. We could use amortized cost accounting, okay? But they're getting rid of the incurred loss model, okay? So when I put this next slide on, it looks complicated, but you'll see in 1 second it's actually very simple. And I'll show you the answer really quickly. So here's what we have. We have a $1 million loan with a coupon rate of 10%. These are the contractual cash flows, right? I make the loan here. I collect 10% interest every year. In the last year, I get the principal balance of the loan plus the last year's interest payment. So these are the contractual cash flows, right? However, in this particular model, if I look off into the future, I estimate some credit losses out in year 3, 4, and 5. These are the percentage of the principal that I expect to be lost. Here's the new accounting. This is called, by the way, this is called the expected cash flow approach. Again, the incurred loss model is gone. Now I'm able to look out over the entire trajectory of the loan, assess loan loss, expected loan losses. Then what I do is, based on these default rates, these are my expected cash flows, right? So what I do is I create, you're all aware of the internal rate of return calculations. What discount rate equates these expected cash flows with today's principal? Answer, 8.84%. That's what's called the effective interest rate on the loan now. Okay? So everybody see, all we're going to do now is we're going to go out, estimate our loan losses over the entire life of the loan, and embed that in the interest rate. Then we're going to record interest revenue at the expected effective interest rate. So notice my interest revenue in the first year is going to be $88,396, which is just 8.84% of the outstanding principal. Okay? But I actually would have collected the full $100,000 here. So here's what my new journal entry will look like. I get $100,000 in cash, but I'm only going to record interest revenue of $88,396. This difference now becomes my new loan loss reserve. Okay? So it's an effective interest rate methodology. So notice that instead of actually basing my loan losses on incurred events that happen, I'm going to use my estimation of future loan losses, and I'm going to embed that into a smoothing device. Because now the loan loss provisions are simply going to be amortized into the income statement through these lower interest revenue amounts over the entire life of the loan. So there's a smoothing element to this as well. You need these things here. Absolutely. Where do those come from? Absolutely. And in fact, let me show you what happens when they change them. Okay? And by the way, under this methodology, changes could be good or bad. In other words, I could as I move through the life of the loan, I could estimate that things are worse than I originally expected, or I could estimate that things are better than I originally expected, and it will allow me to actually record gains or losses at that time. So again, really simple. This is the last example here. This is the same example I just showed you, except when I get to the end of period 2, all the expected default rates go way up. So they were 1, 2, and 3%. Now they're 2, 4, and 8%. Okay? So what I'm going to do is I'm going to readjust my cash flows. I'm going to make a big one-time adjustment here to catch up for that change in cash flows due to the increased estimate of future expected loan losses. My point here is this could also be a gain. It could go either way. This is not conservative accounting. Both sides are allowed into this. So the question then becomes is what's going to discipline banks in terms of these future expectations? Given that we're basically talking about breaking the anchor that's always been there, which is this incurred loss model, which has its roots way back in time to prevent banks from playing with the numbers. It's always been everybody's known that the incurred loss model gives you sometimes crappy numbers, but at least they can't muck with them as much as they might be able to muck with these. Okay? But notice that the two organizations now are on different tracks. That's politics right there. That's the European Union exerted intense pressure on the, now, trust me, the FASB is experiencing intense pressure for the banking lobbies on this fair value thing as well. So who knows whether they'll be able to get that through or not. But you can see that there's splits already developing. So maybe we should again, my argument would be let the ISB go out and try the expected interest rate models. Let's see what happens. Maybe it's crap, maybe it's great, right? But we could watch their experience and then decide whether it's any good. Steve. I'm going to actually turn to my research here now, but you want to? Okay? So that's the world as we know it. The question is this a good thing or a bad thing? Here's what I want you to bring out of these examples that I've just showed you, because that's where I'm turning to the research design, is the incurred loss model which has always been out there, even though there's certain things about it that are definitely not good, and we could criticize it, it's always been anchored in the fact that you've got to show me something that's occurred. You've got to make an argument based on some kind of event, where now I'm going to allow banks significantly more discretion. Is that discretion going to be a good thing or a bad thing? That's kind of where I'm going. Yeah.
It seems to me, self-fulfilling. The bank is saying it's creating a 248, and they don't. Obviously, they don't know 248, but that's what they think. And investors in years 3, 4, 5 are going to think it's worth less just based on a prediction that was made in year 0. So how does it seems like they would look to less.
Oh, here's what I always say about earnings management. Sometimes I need more, sometimes I need less, right? It all depends on what's going on, right? Because I could just mount up on this.
Circumscribed by standards, can they not?
No, I don't think so. Now, to answer your question, I mean, I think the answer here is that they're absolutely giving more discretion. The question is can they build some kind of circuit breaker into the system? And the circuit breaker, I believe, and many people believe, if you want to go this route, is going to have to be a lot more, not more, but better risk disclosures so that outsiders could scrutinize the assumptions themselves, right? You need some kind of counterbalance to simply allowing the bank to make decisions in a haze, and then you just have to accept it. So I do think that it's possible to make this work, but this market disciplining edge that I've been talking about, meaning that the external market has to have information in order to scrutinize, will be a key part of that recipe. So it's not impossible. But let me turn to the research. I got a few minutes left. Now, these things right here that I'm showing you, these are all hypothetical. They don't exist yet. So I'd love to study these and give you the answer, but I can't. Okay? So here's what I'm going to do instead. I'm going to look around I'm going to use the whole world as my my sample now. And because I can't test these, what I can do is I could go around the world now and I could say, where in the world in what countries are banks given more discretion on their loan loss provisioning than in other countries? So I'm going to actually go out and we're going to compute discretion. And we're going to say, I can't tell you what's going to happen with these rules, but I can tell you what they do at discretion that I'm already giving them. Right? Are they using that for the forces of good, or are they using that for some other reason? Right? That's going to be the basic premise here. And again, this is the fundamental tension, right? If I give banks more discretion on this loan loss provisioning, the hope is that they'll use that for truth, light, and justice, meaning that we'll incorporate into our loan provisioning better information, because we're now going to break this anchor to the incurred loss model, and theoretically, we're going to allow a much wider information set to be embedded into our decision making, and theoretically, if it's done correctly, more information could be reflected in the numbers, and we can get better numbers. But of course, on the other side, if I give banks more discretion, it also gives them discretion to act opportunistically, right? And if they act opportunistically, fundamentally what could happen is that discretion could lead to the banks being more opaque, meaning it's going to be harder for me to figure out what's going on because now they've had all this discretion and they're using it to muck with the numbers. Okay? So this is what we're after in a sense, okay? So here's what we do. I'll just briefly kind of describe what we do because I've got 10 minutes here. If you want the study, I'll send it to you. We're going to go country by country, So in the end, you'll see we have 23 countries in this design, many, many, many banks in those countries. And we estimate country by country how much discretion are they allowed in their loan loss provisioning, okay? Based on that measure, we're going to rank countries by the amount of discretion in loan loss provisioning. So then the question becomes, are they using that discretion for good or evil, right? And first of all, people are arguing that if we want to give banks more discretion so that they, in other words, they could bring the future forward. They could reach out and bring loan loss provisioning and information about the future into the present. Question, in countries where there's more discretion, are the loan loss provisions more forward-looking? Okay? Secondly, and this is the transparency one. And let me just quickly set this up. The heart and soul of prudent bank regulation is capital. And the basic notion that's pretty much been accepted in the universe is that the level of capital that banks hold should be a function of how risky the left-hand side of their balance sheet is. In other words, the key notion is risk-adjusted capital. So capital should be based on the riskiness of your assets. And so the notion there is that if a bank's asset portfolio gets more risky, I should see more capital being required and vice versa, okay? So here's our fundamental research design, and I'll show it to you in a second, is based off of that exact logic. We're going to ask the question, in countries with more discretion, how strong is the link between risk and capital relative to countries with less discretion? So in other words, if more discretion is allowing them to muck with the numbers, that could be making the bank more opaque and making it harder for outsiders to impose pressure on them to hold capital in response to changes in risk. Does that premise make sense? Okay. Okay, 10 minutes, relax. Okay. Man, just like pounding this stuff out. Just quickly, I'll just try to give you the insight of how we measure discretion. So in an incurred loss model, the loan loss provision should be based on things that have already occurred. One of the fundamental measures of things going bad in the loan portfolio are what are called non-performing loans. So what we do is we create a vector of variables that we believe are capturing current deterioration in the loan loss portfolio. And we run a regression where the left-hand side is the loan loss provision, the right-hand side is the determinants of the incurred loss model, okay? Then what we do is after we control for all those determinants of the incurred loss model, we throw in the level of profits before loan loss provisioning. The basic idea is this. Once I control for all the characteristics of the loan portfolio, the level of earnings should have nothing to do with what my loan loss provision is, right?
Not in the real world.
Well, I'm not saying what they do, I'm just saying conceptually it shouldn't. So in fact, what we find is internationally, banks generally smooth. What that means is that when their earnings are unusually high, they throw more into the loan loss provision. When it's low, they throw less in. We get strict earnings smoothing. So our first measure of discretion is we rank countries based on the amount of earnings smoothing that's going on through the loan loss provisioning. The second measure is very, very related. We simply throw earnings. We run it without earnings in it. Then we throw earnings in, and we ask, how big an impact did earnings make in the regression? So all of you are aware of the R squared off of regression. We simply measure how much the R squared increases by throwing earnings into the regression. The basic notion is if earnings is very influential, then they have a lot of discretion because they're choosing their loan loss provisioning based on some variable that shouldn't determine their loan loss provision. Okay? So we rank all these guys. And the grand finale. These are there's actually more, but I picked out these two because they're the most intuitive, I think. The first one we did was, does discretion lead to more forward-lookingness? So what we do is, we run this at the bank level for all these countries. That's the regression with a ton of other stuff in there. So notice on the right-hand side here is the loan loss provision at time t today. On the left-hand side is the deterioration in the loan portfolio tomorrow. So in other words, if my loan loss provisioning is more forward-looking, it should do a better job of predicting future deteriorations in loans. Here's what's important here. Under the incurred loss model, there should be no relationship there at all, right? Because the incurred loss model is based on things that have already occurred. I should suck that in, but it shouldn't depend on anything that's going to happen tomorrow, right? Unless there's a correlation in, yeah, exactly. And so you actually control out for that correlation, but you're right. What we find is no difference between high discretion and low discretion countries. So in other words, they're not injecting their loan loss provisioning with more forward-lookingness when we give them discretion. So whatever they're doing with it, it's not making it more diagnostic of the future. Secondly, and this is the main result, on the left-hand side, we put changes in bank capital. On the right-hand side, we put changes in risk. We basically get this by using an option pricing framework. We extract out the volatility of the firm's assets using a classic option valuation technique. So look at what this says. This is the fundamental notion of bank capital, that it should be risk adjusted, that it should respond to risk. So in other words, if the riskiness of the bank's assets goes up, there should be a response in change in bank capital. It should go up. This B coefficient on the change in risk is capturing the intensity with which changes in risk are impounded into changes in capital. Okay? So what we do is we estimate this for a high and low discretion countries, and in fact, what we find is in countries with high discretion, B is significantly lower. So in other words, when discretion is high, the relationship between changes in risk and changes in capital are dampened. So remember earlier in the talk, I was talking about the notion of market discipline and putting pressure on banks to be prudent. Well, what this shows is in countries where there's a lot of discretion, there's less discipline being placed on bank risk taking. And again, this is the current experience could be different because they could try to put some of these circuit breakers in that we were talking about. But notice that the double-edged sword of discretion is real here. So our argument from this paper is we just got to be really careful here about this because there's a downside to this. The incurred loss model is not existent for no reason, right? It's got a certain knowledge or understanding of human nature embedded in it where, again, in a perfect world, you go, man, we could just get all this truth in the financial statements. The problem is you got humans making the decisions, right? And humans are, do things. So I don't know. How confident are you that we're going to get more forward-lookingness that's going to be actually hard forward-lookingness? I don't know. Secondly, and I think this is the big issue here is if we give banks like a lot of discretion, are we going to get into this thing where the banks and their regulatory buddies could basically be the only ones that know what's going on, right? Where we degrade the transparency of the mechanism so much that the external discipline that puts so much pressure on companies to do the right thing, to survive, and for CEOs to hold on to their jobs, is that going to be degraded by allowing the numbers to be basically mucked with? And I think this is the deep issue, I think, of the moment. And so I kind of end it with what I think is I think you muck with transparency at your own risk. I think the notion that we want to degrade the transparency of our financial system to create financial stability is a bad idea, right? I don't buy that, you know, the fire in the theater argument that Steve's making. You hear that one all the time. You know, transparency is going to make, you know, the system skittish and people are going to be running for the door. Maybe, right? But again, I don't want to be burned alive, right? And the question is, hey, I'll buy the following argument. Right now, maybe I wouldn't change transparency right at this minute where things are so delicate because we're already in a crisis. But the question is, on an ongoing basis, are we more or less likely to find ourselves in another crisis if we make the banks more transparent or less transparent?
In a sense, though, I think isn't your argument that discretion can lead to lower transparency based upon historical results and looking global?
That's my argument, exactly.
But the converse doesn't necessarily have to be true, which is that you can have discretion without potentially the sacrifice in transparency if you have sufficient, if you embody regulatory change with it. Because your historical examples depended upon soft regulation and discretionary regulation in a sense, right? So it's a little bit of mixed fruit.
Yeah, absolutely.
On the proposal.
But at the same point, what I could say on that is, the way you were just describing it, I was just feeling, you know, like the master watchmaker. You know, you put in this little thing, and who is the master watchmaker, though, right? Yeah. I mean, who's the one that's making all the decisions? The problem is you got power grabs, and you've got all kinds of things going on where you might unilaterally change. Maybe accounting's the weak link. Maybe we can break the accountants politically and get some changes driven through because that's the political weak link, and nothing else really good changes, right? What happens then? So, hey, I'm not saying that there's not some configuration that can't be done that makes things better, but there's a lot of moving parts in this watch, and you know, you don't want to change one of the gears without making sure you change all the other ones so that the thing keeps time. Okay, one more, yeah.
Just, I mean, doing it differently doesn't necessarily mean discretion. In other words, if you can do a better job, you could be more transparent, right? If you could be more accurate. Now, in the examples that you showed of projected default rates,
yeah.
Okay, if you have done a set of mortgage originations, let's say within 6 months, that have similar characteristics,
Yeah.
that portfolio is going to follow a pattern, and you can calibrate that pattern fairly well in the first year and predict what those future losses are going to be.
I think that's
Now, if you
easier
could
for the
incorporate-
homogeneous loan portfolios than the heterogeneous ones.
Well,
like
what
commercial
about, you know,
loans
you
and-
can do it with your credit card mailings, you can do it with so many other things. So if that information can be used, it wouldn't hurt transparency to use it. That's my only point. No,
No.
absolutely not.
I mean, aren't default rates at record highs now? That's the problem.
No, that's if
They
you
are
looked.
record
Yeah, they are. If you look at each class, each year of origination, because the underwriting standards change from year to year. So if you look at each year of origination and you look at similar characteristics on origination, loan-to-value ratios, everything else, you'll find a pattern, and you can calibrate that pattern, saying, okay, this is what happened in the first year, so this is what I can reasonably expect to happen in the third, and by the fifth year, perhaps we'll have reached some sort of a plateau. That sort of stuff stayed reasonably stable. So you can use that information, but again, it's very complicated.
It's a double-edged sword.
Yeah,
The
in a
question
real
is,
world-
what are the checks and balances?
Yeah, exactly.